Welcome to this episode of PhillipCapital's Market Watch. I'm PyTCH, Head of Research from Phillip Securities Research. Today, I will be discussing the Singapore equity strategy for 2024 called The Federal Reserve's Got Your Back. Let's start with the three macro themes that will set the investment backdrop for 2024. Firstly, we expect US growth to slow down in 2024. Although there are positive headline job additions, the underlying trend for jobs is slowing. Economically sensitive jobs in manufacturing and services are slowing down. What's holding up demand are jobs less exposed to economic fluctuations such as government payrolls, healthcare, and social work. US economic growth surprised the market due to a huge $1.3 trillion stimulus by the US government. It represents around 3.5% of the GDP or half of the US economic growth in 2023. We expect a fiscal drag on the US economy in 2024. Social security spending is expected to expand by $48 billion compared to the $148 billion spike in 2023. The inflation or cost of living adjustments will likely be smaller in 2024. Other contributing factors to the fiscal drag include higher tax collections following the delay in California tax filings and increased capital gains tax following an equity rally in 2023. Additional pressure points on consumer spending include student loan repayments and the depletion of excess savings from the pandemic stimulus. China's economy is expected to remain sluggish in 2024. Formerly accounting for about 1/3 of global growth, China is unlikely to continue as a major driver of global economic expansion. The country faces significant structural challenges, particularly in investment demand, which accounts for 30% of the country's GDP. As China transitions from investment-led growth to consumption-driven model, this shift is likely to stall growth rates. The Achilles heel for China is fixed asset investments, which have decreased dramatically. From peak growth rates of over 30%, investments are now growing at a 3% pace, reaching record lows excluding the pandemic period. The private sector is still holding back their investments with a decline of 5% in 2023. The continuing decline of the residential market is a source of deflation, with property sales declining at a 20% pace. The second key theme for 2024 revolves around anticipated interest rate cuts. Inflation continues to trend lower and could hit the Federal Reserve's target of 2% by end of 2024. This is based on the trend line of inflation over the past 3 months. Notably, the stubborn housing or rental inflation has started to decrease. Another factor contributing to the lower interest rates is the Federal Reserve's readiness to make preemptive cuts. With growth beginning to slow and considering the delayed impact of interest rate changes, we believe the Fed will be prepared to cut rates preemptively, possibly before any significant weakness in the economy becomes apparent or the inflation rate reaches its targeted 2%. In Singapore, we expect below-trend growth in the near term due to weakness in global economies and sluggish domestic demand. However, structurally, there are reasons for optimism. Foreign direct investments are still at record levels of around $120 billion, significantly exceeding pre-pandemic figures. In addition, population growth reached record additions of 281,000 in 2023, with a growth rate of 5%. In conclusion, any potential downturn in economic growth is likely to be mitigated by the Fed's readiness to cut interest rates. The sectors we favor include conglomerates due to favorable demand-supply conditions for power, REITs as beneficiary of interest rate cuts, and telecommunications as mobile prices start to reprice higher in most countries in the region. With that, I'd like to end this segment of PhillipCapital's Market Watch. Do remember to like the video, subscribe to us on YouTube, and follow us on our social media handles. Thanks for joining us and see you soon.